today I want to go over with you dividends. Not only how to record each kind of dividend that a corporation might issue, but also its impact on the stockholders' equity section of the balance sheet. I chose this topic because I know it is a little bit different from what we've maybe learned in the past. And I wanted to remind you that if you do have questions on other topics, specifically in this chapter, they go over how to calculate those preferred stock dividends, whether they're cumulative or non-cumulative, and they go over how to record treasury stock. Remember, if you need a little bit more guidance on those topics, we have those 5-minute videos that are included in Blackboard, and they will address these topics. Just open up that 5-minute video tab, search for those two topics, and you'll get a quick refresher on those areas. But since these dividends go a little bit deeper, I wanted to make sure that we addressed these. So I took this picture right out of your book. It shows you the impact of the different dividends on that stockholders' equity section. And we'll go over each kind of dividend. You have a cash dividend, you can have a small stock dividend, a large stock dividend, or a corporation can do a stock split. So as you can see, this chart shows you the impact that they have on that stockholders' equity section. I want you to notice a few things. First of all, every time we give stock out as a dividend, it's going to increase that number of shares. One interesting point is that this declaration of dividends, anytime we declare the dividend, it's going to affect our retained earnings. So not when we pay it, but when we declare that dividend, that's when it affects retained earnings. The other piece I want you to remember is that when we pay a cash dividend, we need to have cash, right? Because it's going to decrease our total assets here. But the other impact of paying a cash dividend is this decrease to our working capital. And just as a reminder what working capital is, working capital, a basic definition of that is the difference between your current assets and your current liabilities. So it's showing you how liquid your company is. How quickly can you pay those bills and things like that. So we want to make sure that we have enough cash to pay a cash dividend. Even though it comes out of retained earnings, we still have to have that cash. And what impact taking that cash out of our balance sheet is going to have on our overall impact to our ratios and what investors are looking for. So let's go through some of the journal entries for the different types of dividends, and then we'll look at the impact they have on our retained earnings and our additional paid-in capital and stockholders' equity in general. So if it is a cash dividend, if the company has some cash to pay out, they decide to do a cash dividend, we are going to debit our retained earnings and we're going to then credit our dividends payable. And this is for the amount of cash we're going to pay. So usually they'll issue like 50 cents per share. Or something like that. So you can see again, when we declare is when we're going to hit that retained earnings. The only time I'm going to address the record date is just in this first one. Nothing happens at the record date. There's no entry that you need to do. What this says is that anybody who owns shares on this date, that's who's going to get this dividend. And then we have the payment date. That's where the cash comes out, where we decrease that cash. So we will debit our dividends payable, reduce that liability that we created at the declaration, and pay our cash. And it's going to be for the same amount. But again, you have to have cash to pay a cash dividend. So let's look at some of the other situations. The first one is a small stock dividend. If you have a small stock dividend, you're talking about a dividend that's less than 25% of your common shares outstanding. And if it is a small stock dividend, this is going to be recorded at your fair market value. So let's look at the journal entries that would be required for a small stock dividend. Again, at that declaration date, we're going to debit our retained earnings. But again, this is going to be for the fair market value. Then we're going to credit our common stock dividend distributable. Luckily, your homework has drop downs, so you don't have to type this out every time. This is going to be for your par value. And then you're going to put the difference into a credit to your paid-in capital. Again, grateful that your homework has drop downs. You don't have to type all of this. And we're going to identify this to be our common stock. And again, that journal entry is for the difference between your fair market value and your par value. At that payment date, we're just going to decrease that liability by debiting our common stock dividend distributable. Again, this is for our par value. That's what we recorded it for to begin with. And then our debit is to common stock. Or sorry, our credit is to common stock. Said debit, wrote credit. This again should be a credit to common stock at par value. So that's a small stock dividend. What happens if it's a large stock dividend? A large stock dividend is identified as more than 25%, and then we record it at par value. Your book talks about this, comparing it to a stock split, but they call it like a split up. I think that's kind of confusing. Just look at it as a large stock dividend and know it's treated differently than a small stock dividend. So at declaration date, we're still going to hit that retained earnings. So we're going to debit our retained earnings. But this is going to be for par value. And then we're going to credit our common stock distributable. For that same par value. You'll notice there's no paid-in capital. Come payment date, we're going to get rid of that liability. Debit to that common stock dividend distributable for par value, and credit to our common stock. So you can see a little bit of the difference between the large and the small stock dividend. Now let's talk about a stock split. stock split, the big thing to know is there's no journal entry. No journal entry required for stock split, because all it is doing is changing the number of shares and the par value. We only record a journal entry if it has a financial impact to the company. This does not. So for example, let me change this. And if we have a $20 par value, 100,000 shares of common stock, what a stock split is going to do, change that to a $10 par. If this is a 2-for-1 stock split, as most of your examples are, we're going to double the number of shares, but notice the value stays the same. So let's look at one of your homework problems, kind of put this into practice and make sure we know how to do it. So this is exercise 15-14. I want to remind you, I don't assign too much homework for graded points because I know that there's a lot of material in this book. But if there is ever time that you say, I get this, but I'm not 100%, there's always that extra practice and homework available to you. So open the extra practice folder, do some more problems in that area, and make sure you have mastered each of those concepts. So let's go through this. Maybe you want to try this on your own and come back. If so, you can pause the video and then you can come back and see if you know how to do it or if you needed help. Otherwise, let's walk through this together and then maybe open up one of those example homework that you don't get points for, but you just want to make sure you understand how to do it. So, walking through this, again, we're going to pull out that information that we need, noting that here's our common stock, how much retained earnings we have, and that our fair market value is $37. Our par value is $10. So for A, we want to record the journal entries that go along with this. A, I can see 5%. That means it's a small stock dividend. So I know from going through those journal entries that we just did, I'm going to debit my retained earnings. I'm going to credit my common stock dividend distributable. And I'm also going to credit my paid-in capital in excess of par common stock. Now we got to figure out the amounts. Remember, retained earnings is fair market value on a small stock. Common stock distributable is par value, and the paid-in capital is the difference. So going through that, I have a 5% stock dividend that I need to issue. So what I'm going to do is take that 300,000 shares, times that by 0.05%, which gives me 15,000 shares. Then I'm going to take that 15,000 shares, times it by my fair market value, which gives me, oops, I forgot 555,000. And that is the amount that's going to go to retained earnings. Then I'll take that 15,000, multiply it by my par value, and that will go to my common stock dividend distributable. And finally, what I do is take the difference here, and that will go to my paid-in capital. So that's A. That's if I declare first. The first one is declaring my dividend. The second piece then is to pay or issue that dividend. When I issue that dividend, I'm going to decrease that liability. And I'm going to credit my common stock. And this is for that par value. Kind of, not what I wanted to do. That didn't do what I wanted it to do. Sorry about that. I wanted to move it down a little bit so you can see the numbers here. I'll just put them over here. Right? So this is number 1. This is number 2 to record that issuance. Now let's look at the second one in B. B says they're going to issue 100% stock dividend. That's a large stock dividend. I wish I owned those shares. Let's see how would we record that one. So for B, again, we're going to debit our retained earnings at declaration. But remember, for a large stock dividend, this is at par value. We have 300,000 shares. They're each worth $10. That would be $3 million. Then we're going to credit that common stock dividend distributable for the same amount. Again, I just took that 300,000 shares. Since it's 100% dividend, we're doubling all of that, and we're going to issue that at par value, which was $10. So that was the declaration. Now let's look at the issuance. The issuance for a large stock dividend, we're just going to decrease that liability. And then credit our common stock for that same amount. One more zero. What about for that 2-for-1 stock split? Remember, there's no journal entry. So in your homework, you're just going to put no entry. But remember what happens for that 2-for-1 stock split. What happens now, if I had this 2-for-1 stock split, this would be changed to $5. This is now 600,000 shares, but the amount, that's going to stay the same. The other thing I do want you to recognize is how these journal entries impact your stockholders' equity section. So all you have to do is really look at those journal entries and apply them. For example, we have your retained earnings right here, right here. So retained earnings, a debit to retained earnings is going to decrease your retained earnings, right? So if I look at my retained earnings here, that's the last one on there, I'm actually going to decrease my retained earnings by $3,555,000. So the impact of these three transactions on my stockholders' equity would decrease my retained earnings to 2045. It's also going to impact my paid-in capital in excess of par and my common stock. All you got to do is go through, find those pieces in your, this should say common stock, find those pieces in your journal entries and add or subtract based on what is happening. For example, common stock. Whenever we issue it, we're going to increase our common stock here and here. We're increasing by 3,150,000. Again, that stock split doesn't change the value, so we would just increase that. So after these transactions, our common stock value would be 6,150,000. So I think you get it, hopefully. Let's look again how would this homework problem look in a multiple choice exam question. So here's our questions. Again, this might be a good place to stop the video. Try to work these out on your own. See how you do, and then come back and play the rest of the video and see if you got it right. It's a good test of where you're at and how much more you need to practice. Okay, so let's go through this. They say Hawk Company, 230,000 shares. Par value is 10. I like to kind of really point that out. The market price is 20. That's my fair market value. They're declaring a 15% stock dividend. That means it's small. And then they're later declaring a cash dividend. So they want to know, what is the total impact on retained earnings? So we really can just do those journal entries we just did in that homework problem and then look at how it impacts our retained earnings. So because they want that retained earnings piece, and I know that by reading the question, all I'm going to look at or try to record is that declaration part, because I know the declaration is the part that hits retained earnings. So to save time on an exam, I know I can just do that piece of the journal entry. So first, let's record that small stock dividend. I'm going to debit my retained earnings at fair market value. I'm going to credit, I'm going to start abbreviating here, my common stock dividend distributable. And I'm also going to credit my paid-in capital in excess of par, common stock. Now let's look at the amounts. I have 230 shares. I want to pay a 15% dividend. And because it's a small stock dividend, I'm recording this at market or fair market value. If I do that math, that comes to 690,000. The second piece is recorded at par value. Par value changes this second part of it to $10. Therefore, it's really only half. And because it was half, the difference is the same amount. That's the first piece, though. The second piece is looking at that cash dividend. Again, we're looking at the declaration piece of that. And we need to debit our retained earnings. Let's put this in a different color so it stands out a little bit more. Debit our retained earnings. We're going to credit our dividends payable. For that second cash dividend. Your cash dividend is how much they pay. But now remember, we have more shares. This is the number of shares we have. So I'm going to take that $230,000. I'm going to pay all of those shares. So I'm going to times this by 1.15%, because that's going to tell me how many shares I have outstanding this 4 months later when I'm paying the cash dividend. And I'm going to take that amount and times it by the 50 cents. And the amount you get is 132. Now they want to know, well, what impact do both of these transactions have on retained earnings? So I have to look, they both impact retained earnings, which means I'm going to add those two numbers together. And I should get 822. So you can see all of these other numbers are plausible. That's because we want to make sure you understand which numbers you're taking. And do you know that they both, whether it's a cash dividend or a stock dividend, that they both impact retained earnings? Now remember, if one of these was a stock split, it would not impact retained earnings. So let's look at one more example of that. This one, same information, except that 40% constitutes a large stock dividend. And what impact does that make? So remember, a large stock dividend is recorded at par value, not market value. So let's, again, I highly recommend not trying to just do math, that you look at those journal entries and see the impact that they have. So I'm going to record my large stock dividend. I'm going to debit my retained earnings. I'm going to credit that common stock dividend distributable. And that's going to be for $920,000. I can get that because I'm going to take those 230 shares. I'm going to issue that 40% dividend, but remember, this is recorded at par value, so that's $10 per share, which should come to $920,000. That's the first piece. The second piece, all I'm going to do is bring that same journal entry down, because it's saying the same thing. We're recording the same way. Debit that retained earnings, credit that dividend payable. So how does that large stock dividend impact that retained earnings? Well, I'm going to go through and add up those numbers again. It's 920 plus the 132. If I look at how it hits my retained earnings, I add those numbers together. And let's see. I think I typed in oh no. 1052. So that would be B. Again, those other numbers are plausible. We just have to understand which journal entries impact our retained earnings and how to record them. So going back up to that original chart, you can see every time we have a cash dividend, small or large stock dividend, it's going to impact retained earnings. So that's how these journal entries impact our stockholders' equity section of the balance sheet. If you have additional questions, please email me, let me know. If you have other questions on other topics, make sure you check out those 5-minute videos on preferred stock dividends and how to calculate how much the common stockholder gets versus the preferred stockholder, or how to record those treasury stock journal entries.